All four indexes higher, but the S&P, the one with the big fun round number, is having a little bit of trouble. Joining us, Joe Mazzola and Sonders with the big picture discussion to close out our session here. Great to see you guys. I'm thinking about our convo from this morning, Lizanne, because we got bonds selling off. Stocks don't really care. It seems like right now there's not a lot to get in the way of momentum other than the stuff we can't see.
Yeah, and for the most part, I think earnings have been supportive. And a day like today, where small caps have been driven in inverse fashion by what bond yields are doing, that's clearly an exception today. But I think a day like this does show you that there is still money that would like to find opportunities down the cap spectrum. So you get these pops every once in a while in an index like the Russell 2000. So it's hard to really square everything that's happened today, but that's the nature of the market. It doesn't always have an explanation.
Yeah, true. We are kind of violating our recent pretty reliable Russell rates relationship, 1.5%. I mean, it's just no matter what happens, Joe, they buy something. That seems to be like the way it's been now for a couple of weeks running. One's tech's down, they buy the Russell. Russell's down, rates are up, yeah. They go to big tech, it's just a game of whack-a-mole that's very bullish.
Well, there's one thing they're not buying, Oscar, and that's protection.
Right.
I mean, we're starting to see some spreads now between the S&P 500 puts and calls that are taking us to, 5-year levels of upside call buying versus downside put buying. So what that says to me is not only you've got an S&P 500 that's pushing 5,000, so you got the bulls out there buying equities, but they're also buying upside calls, reminiscent of, what we saw a few years ago in 2021. Now, it's not the meme stock, so, let's separate some of that from what we were looking at a few years back. But, they continue to pile into the mega caps, and they're looking at every opportunity to do so. I was looking at some of the skews specifically on the mega caps themselves. I'm looking at Apple in the 24th percentile, Amazon 9th percentile, Google 4th percentile, Meta 2nd percentile. That means that in the past 5 years, they have traded higher skews, meaning more people are buying protection than what they're buying the kind of the upside call, 98% of the time than where they're currently trading. So everybody's on the same trade.
I'm looking at VIX right now, to your point, and we've had this creep higher in VIX since December, but at this moment we're about to kind of break down through the lows of whatever that trend may be. It seems like if we get back into low mid 12 handle, we're kind of heading back to the lows of VIX. Is that what you're watching, Joe?
I'm watching that specifically, yeah, because what that tells me is that there is some complacency out there. And now look, Oliver, these are just kind of things to watch for. It doesn't necessarily mean that the market has to roll over because of that. But, what concerns me to a certain extent is when you're at all-time highs and you would expect to see some hedgers come in. We just haven't seen that to, the same level that we have historically. We're just starting to see more and more people on the same side of the same trade. And when things do roll over, we don't know what that catalyst is going to be. Maybe that is as we get closer to that, the first Fed rate cut announcement. Maybe there's some pickup in volatility in the fixed income market, spills over into the equity markets. But I think that, there's got to be some catalyst to kind of push this in the other direction. We just haven't seen that yet.
Yeah, there really is some of that COVID-style call buying kind of coming back. SIBO team put that on our radar, too, about a week or so ago. I got someone on Twitter telling me today, Lizanne, that the earnings reactions are so big this time. I know we're all kind of looking at ARM today as an example, but I wanted to come back to the data you guys have poured through over the season so far. We talked a little bit about the beat rate this morning. What about like the size of the responses? Is there anything interesting going on in that regard?
Yeah, I mean, you're seeing more outsized reactions when you either have double beats or double misses, meaning, a beat on both top line and bottom line, or a miss on both top line and bottom line. But also movements in the individual stocks as a function of what the story was inside the earnings report as well. But there certainly is very rapid punishment of companies that miss both top line and bottom line. And I think that's not a new phenomenon. That's been the case for the past few quarters. And it's just a function of a lot more fine-tooth combing of these earnings releases. And that's why moves in the market go beyond just those headline grabbers of beat rate.
All right. Next week for CPI, since we're in the big picture discussion here, I want to get a quick thought from both of you. Lizanne, you go first.
Well, I think CPI, PPI, the combination is important. Any kind of outsized move one direction or another, I think could move the needle, probably not for the March meeting, but maybe for the calculus around May or June.
All right, Joe, big highlight of next week?
Yeah, I think Lizanne hit the nail on the head. We're pricing in 3 to 4 cuts right now. You see a big move in either direction, and that changes the calculus there. And we'd have to keep an eye on the probabilities at that point.
All right. Nice. Great combo. Appreciate it, guys. Little last macro discussion before we hit some earnings. Lizanne Sonders, Joe Mazzola.